Today, we're going to explain what is a stock. Stock, explained simply, is a partial ownership of a company. What does this really mean? Well, this gives three main rights. One is the claim on the assets if the company is liquidated. Two is voting rights on major decisions and board of directors. And three is a claim on future profits, mostly via dividends. The important thing about stock is you can gain money transacting, buying and selling stocks, but that's different from the partial ownership of a company. So again, partial ownership is you get a claim on assets, you have voting rights for major decisions and board of directors, and then you get a claim on future profits. Most people, when they think of stocks and how to make money, they think of the buying and selling stocks. So buy at a lower price, sell at a higher price. But when you look at a stock from an actual ownership perspective, how you make money is really their future profits of this company distributed to their shareholders through dividends. The bad thing about this is that dividends are taxed, and so a company often and most of the time does not choose to distribute through dividends. They choose to reinvest in themselves, but that's a separate lesson in the future. Let's go through a couple scenarios today. So the first scenario is what exactly happens when a company IPOs to me as a partial owner and person who wants to raise money, you as a person who is investing in this, let's say, tea company, and then others who also want to invest in this tea company. So let's look at all of the parties and see what happens in these scenarios. I want to start a tea company and I want to keep 20% of this company, but I need $1 million raised in order to start this company. So I need $1 million and I do an initial public offering and I do it at $100 a share. So initially I have 2,000 shares and I find some willing buyers. You are one of the willing buyers and you want to purchase 1,000 shares for 10% of the company. And then everyone else wants to buy 7,000 shares. And so now I have 2,000 over 10,000 shares, or 20% of the company. You have 10%, and then everyone else together have 70%. Now, I think it's important to learn what happens in each of these scenarios to everyone's ownership, the price of the share they can sell at, and the earnings per share. So we want to keep track of one, what is the ownership, the price of the share, and finally, what is the earnings per share. So let's say hypothetically, our company, our tea company, makes $100,000 our first year. So our profit is $100,000 for one tea shop. So that means if our profit is $100,000 per tea shop, so that means that if our profit is $100,000, we have 10,000 shares out, our earnings per share is then 100,000 divided by 10,000, which is $10. Now, let's say hypothetically we want to sell all our shares, right? What can we get for this? Well, we initially priced it at $100 per share. It's still $100. So if I sold all my shares, that means I could get $200,000 if I sold all my shares in the market hypothetically. And if you sold all your shares, you could get 100 and everyone else could get 700K if they all sold all their shares. Now, earnings per share is important to track because we can conceptually think about, okay, how much profit would all my shares generate as a partial owner of this company? So how much profit all my 2,000 shares would generate per year would be 20,000. Yours would be 10,000. And then everyone else's would be 70,000. Now, this does not mean how much money we're going to get because we own these shares. Because remember, partial ownership gives profits through dividends. But what this means conceptually is that all my shares as a proportion of the company, they earn about this much profit per year. So good to kind of keep track of. All right, let's go to our second scenario. So let's say my company, my tea company is doing awesome and I want to expand. I want to do 2 more stores and each of these stores are going to cost $1 million each. So I need $2 million more. So in my second scenario, I'm going to be issuing new shares to expand my company. And let's say because people kind of like this company, they think it's going somewhere. So now the price has gone from $100 per share to $200 per share. So because the price has gone from 100 to 200, let's do some simple math. How many new shares do this company need to issue in order to get that 2 million? Well, that'd simply be 2 million divided by $200 per share. So that means we need an extra 10,000 share that we need to sell to everyone else. So I still have the 2,000 shares, you still have the 1,000, but now everyone else in total have 17,000 shares. And our percentage of ownership of the company is then our shares divided by the total amount of shares out there. So mine would be 2,000 divided by 20,000, which is 10%. Your new ownership would be 5%, and then everyone else's ownership would be 85%. Okay, now what is the earnings per share now? Well, earnings per share, again, is based off our profit of the company, right? So let's say that because now I have 3 tea shops, my profit has expanded to $300,000 per year. Now, because my profit's now $300,000 per year, my earnings per share is my profit divided my total amount of shares out there. So that would be 300K divided by 20K. Let's think about it from 2 perspectives. One is earnings per share of myself. That means my shares conceptually contributed 30,000 per year. Your shares conceptually contributed to 15,000 per year, or 1,000 times 15 earnings per share, and then everyone else 255,000. Now, if we all sold all our shares at this point, how much money could we get? Well, if I sold all my 2,000 shares at $200 per share, I could get $400,000. You could now get 200, and everyone else, if they sold all their shares, could get 3.4 million. Now let's look at the final scenario where our tea company wants to buy back our shares because we feel like the shares price is actually too low. We think it's going to be worth more in the future, so we're going to buy back 6,000 shares. And let's say the share price has reduced from $200 to now $150. So we feel like, oh, the shares are pretty cheap right now. They're on sale. Let's buy some back. And this way we don't have to distribute out as many profits to other people. Okay, so if we bought back total 6,000 shares, I still have 2,000 shares. You still have 1,000, but now everyone else, they only have 11,000 shares in total. So if you do the math, our new ownership percentages comes out to this. And our new earnings per share is now, let's say the profit is still 300,000 per year, divide by the total amount of shares out there, which is 14,000. And that equals to about 21 bucks. All right, well, let's go back to our 3 dimensions of what we want to think about, right? Ownership, share price, and earnings per share, because they each may increase or decrease, but that doesn't mean the other ones will increase and decrease with them. And this is very important to understand as an investor, especially in these 3 major scenarios. So our earnings per share, hypothetically, because I have 2,000 shares, if I did the math, I multiplied my number of shares I have by the earnings per share, I would get about 42,000. And if I did the math for you and everyone else, these are the numbers. And because the share price has now decreased from $200 to $150, if we all sold our shares, hypothetically, this is the amount of money we can all get. Now, finally, what happens with our company? Well, our company has bought back 6,000 shares, so this now becomes what we call treasury stock in our assets, liabilities, and equity. So because our company has now bought back 6,000 shares, this now becomes treasury stock. So treasury stock, usually a good thing. That means that a company believes in itself and has bought back a lot of its own shares. So let's look at our 3 dimensions again. Ownership, price, hypothetically, if we could sell all our shares out, how much money we could get, and our earnings per share. So we went from doing an IPO to expansion to now share buyback. So our ownership changed from when we went from an IPO to an expansion. But even though your and my ownership decreased, our earnings per share actually increased. And what we could have gotten the stock in the open market also increased. So even though our overall ownership decreased, this wasn't necessarily a bad thing for us because we could still get more money if we sold all our shares, and our shares also made more earnings per share. Now, when the company did a share buyback, because the price of the stock decreased, what we could get in the open market for all our shares obviously also decreased, but our earnings per share increased because there are less shares out there. So hypothetically, all our shares, your and my shares, at least my 2,000 and your 1,000 shares, they all represented a higher earnings value in terms of that partial ownership of the company. So the key lesson here is that ownership, your earnings per share, and the price of the stock you can get in the open market, they're all interrelated, but they all don't necessarily move in the same direction. So as an investor, keep track of why these three things change, if they are good for you or bad for you. And then these three scenarios are three major important scenarios to know. So what is a stock? It's partial ownership of a company. You get a claim on the assets of a company is liquidated. You get voting rights on major decisions and board of directors, and you get a claim on future profits through dividends. But the important thing is to realize what happens to your shares in these three scenarios. All right, thank you for your time. Cheers.